Hey, what's up everyone, and welcome to the School of Personal Finance. So a few months ago, I received a viewer question asking my thoughts about using a home equity line of credit to pay off her mortgage faster. And even though I had my response in my head, I thought, you know what, let me watch some YouTube videos on it, see what I could find on the internet, what other people are saying about it. And boy, did that bring me down the rabbit hole. So I found these videos that had like millions and millions of views on them and thousands of comments talking about how you could pay off your mortgage in 5 to 7 years, throwing terms around like velocity banking and how the banks rip you off and they front load the interest. So after watching these videos and reading through the comments, I quickly realized that people really don't understand how mortgages work and how the interest works and how home equity lines of credit work. So in this video, I'm going to do my best to make it simple for you, explain how all these things work, so then you can decide for yourself what the best way is if you want to pay off your mortgage quickly or not. I'm also going to give you my 5 best tips for actually paying off your mortgage faster without using any of these, terms that people are throwing around. And spoiler alert, my 5 tips, they're not revolutionary. It's pretty simple stuff where anybody could do it out there. So let's go ahead and get to the video. So now if this is your first time here, I talk all about personal finance and investing, saving money, and just overall trying to help you become great with money. If that's something that you are interested in, hit that subscribe button for me and check out my other videos. All right, so let's start with mortgages. Let's make the assumption that you're taking out a $300,000 fixed rate mortgage, 4% interest rate over a 30-year period. So now with a mortgage payment, you have 2 components of it. You have the principal and you have the interest. And the bank uses an amortization schedule. So they calculate exactly how much you must pay every month over a 30-year period. So at the end of it, you owe 0. Now that monthly payment that it spits out of this amortization schedule, it does not change. So even if you're going to pay more each month or you throw extra money at reducing the principal, your payment is going to stay the same. What's going to change month to month are those 2 components, the amount that goes towards principal and the amount that goes towards interest. And now the amount of interest that you pay every month, it is a direct mathematical calculation compared to how much money you actually owe at that time. So if we look at the first month, that's when you owe the most. You owe $300,000. If we do the simple calculation, 4% of $300,000, that is $12,000. Divided by 12, how many months there are in the year, that comes out to $1,000. So in that first payment, you owe $1,000 worth of interest. And that is the most that you are ever going to owe because your payment in this scenario is $1,432. So $432 is going to go towards the principal to reduce the amount that you owe, and $1,000 is going to go towards the interest. And then they do the same calculation all the way through. So for month 2, you just paid down $432. So they're going to take this new outstanding balance that you owe, they're going to multiply it by 4% divided by 12, and that is the interest payment for payment number 2. And now the amount above that is what's going to reduce the principal, and it's just going to continue. Your monthly payment is staying the same, but the amount that you pay towards principal is going to go up a little bit each month, and the amount that you pay towards interest is going to go down a little bit each month because you owe them less money. So if you decide, you know what, I don't want to pay all this interest over 30 years, I would rather pay the bank less interest, then all you need to do is owe them less money. It's simple math. And another point that some people don't understand is that with this monthly mortgage payment, because it accrues monthly, you don't gain anything by paying on the 1st of every month as opposed to paying on the 10th of the month or the 15th of the month. It actually doesn't make a difference. So you could pay your mortgage on the 15th of every month and you're still going to owe the same. You're not accruing additional interest by doing that. Where it's the exact opposite with credit cards and with home equity lines of credit, where the interest accrues daily on those. For those, you have a benefit by paying on the 1st of every month as opposed to paying on the 8th of the month. So let's look at an actual amortization calculator that I found somewhere online, and we'll just play around with the numbers based on this $300,000 mortgage, 4% interest over a 30-year period. And we'll throw some extra principal payments here and there and see what kind of difference it makes as far as paying the loan down faster. So if we see right here, we have our mortgage amount, $300,000, 30-year term, 4% interest rate. That gives us the monthly payment, $1,432. if we look down at the bottom here, we see the total payments that are made over the 30 years, $515,000 and change. And of that, you have paid $215,607 in interest. So you might say to yourself, holy cow, that's a ton of interest. I could buy another home for that amount. But that's just the way the numbers work. If you want to borrow 300 grand over a 30-year period, that's how much interest you're going to pay. So if you say, screw that, I'm not paying that much interest, I'd rather pay much less interest. So if we cut it down to a 15-year mortgage, now you've cut the interest down over that 15 years to be $100,000. But if we look, your monthly payment has now jumped from $1,425 a month. Now you have to pay $2,219 a month. So now let's go back to a 30-year mortgage, and let's say, you know what? I get a tax return once a year of around $3,000. So I'm going to take that and I'm going to prepay my mortgage every year around April or whatever when I get my tax return, and I'm just going to throw it at my mortgage. So if you do that, if you pay $3,000 yearly throughout the term of this mortgage, you would save $61,410 on there. And if we scroll down and look, you would be done with this mortgage in 22 years and 5 months. So you save basically a little over 7.5 years by just throwing $3,000 a year, once a year, extra towards your mortgage. Now, if we say, you know what, I can't pay on that 15-year schedule, but I can pay an extra $400 a month towards this thing, so I don't have to pay so much interest over the 30 years. So if you throw an additional $400, you will save $81,000 throughout the term of this mortgage, and you'll be done with it in just about 20 years. 19 years and 10 months, you'll be done with this mortgage. Total savings, $81,000 in interest. So now let's take a look at how home equity lines of credit work. So home equity line of credit is just a revolving line of credit, very similar to a credit card. The big difference is that your home is a collateral. So you have to apply for it. You have to have the equity in your home to get approved for it, good credit score, all that stuff to get approved for it. But with a home equity line of credit, the money that you borrow on it, the interest is calculated daily. That's different than with a mortgage where it's actually calculated monthly. So if you borrow $10,000 on your home equity line of credit, the interest is accruing at a daily rate. So they take your interest rate, say it's 5%, and divide it by 365 days a year. So they're looking at how much you owe on that home equity line of credit every single day and calculating the interest on a daily basis. And then they add it up at the end of the month to come to your interest payment for the month. So now, because the interest is calculated daily, you do save money by paying it by the due date or a little bit before the due date, where it costs you more if you wait and you don't pay it till 10 days after the due date, because the interest is being calculated each and every day. In the home equity line, it's revolving. So let's say that you borrow $5,000 on it and then you pay it off. Now you have it available again, just like a credit card. It's pretty simple to understand. So now the concept of velocity banking that these videos are based upon, how you could pay off your mortgage in 5 to 7 years, it's that you get a home equity line of credit. So you have your mortgage, you take out a home equity line of credit, and you use a chunk of the home equity line of credit. Let's say it's $10,000, and you prepay your mortgage with it. You throw it at your mortgage so that you're reducing the principal balance of that mortgage. And now by doing that, you are now reducing the interest that you owe on that mortgage because you owe $10,000 less on it. Even though you're still going to be making the same monthly payment on your mortgage, you now owe 10 grand less. So more of your mortgage payment is going to go towards the principal. So this is going to accelerate the pay down of your mortgage. But now you owe 10 grand on this home equity line of credit here. So what velocity banking is you use this home equity line of credit as your cash account, basically is like your checking account. So when you get paid, you put your paycheck in there. You take your paycheck, you pay down the line of credit. You then pay your bills out of the home equity line of credit. And you keep on doing this, using it, paying it down, using it, paying it down. And you just have a focus, you have a goal of paying it back down to zero and then doing it over again. So instead of having money sitting in the bank where you earn zero interest on it, you have it sit in the home equity line of credit because this is accruing daily. So if you park your paycheck in your home equity line of credit, you're not paying interest on those days because you have paid down the balance on it. And then when you actually need the money to pay a bill, you write a check out of the home equity line of credit to pay a bill. Now, in theory, this could work if you're very diligent, if you watch it very closely, if you don't, continue to use the home equity line of credit and spend more than what you typically spend, because now you have all this money that's available to you. But if you're very disciplined and you stay all over this, then yeah, you could save money by using the home equity line of credit through this velocity banking idea. Personally, I think that it's way too involved and way too confusing, and it's just not really necessary. So if paying off your mortgage early is one of your goals and you're focused on doing it, here are 5 tips that I have to help you get there. All right, so number 1 is pretty earth-shattering, and it's just make random extra principal payments towards your mortgage. So if you have extra money laying around, go into the bank and throw some money at it. Make a principal payment. Make sure you're telling them that it's a principal payment, because if you don't, they'll apply it to your next monthly payment. So go in and throw chunks at your mortgage if you have the money laying around. That's the best way to pay off your mortgage early. Tip number 2 is to do the bi-weekly payments. So by doing this, instead of making 12 monthly payments, you're making 26 bi-weekly payments, which is the equivalent of 13 full payments. So you get 1 extra payment a year by doing bi-weekly payments throughout the year. And that 1 payment a year goes directly towards principal, and that'll knock years off the back end of your mortgage. So that's a simple way that you could go about getting done with your mortgage faster. So then my 3rd tip is to just make payments as if it was a 15-year mortgage. So I still think that it's a good idea to do a 30-year mortgage, but if you want to pay it off quicker, make payments as if you took out a 15-year mortgage. This at least gives you the flexibility where if you don't have the money one month, you could make the payment as if it was a 30-year. But if you do have the extra money and you want to make the additional payments, pay it on that 15-year schedule and try to pay it off that much faster. And then tip number 4 is to check your current interest rate. Rates are crazy low right now, and see if refining makes sense for you. The key is, can you save enough on the interest rate to make it worthwhile? So you have to see how much the closing costs are and the interest savings that you're going to have over the life of it, and make sure that it makes sense to do that. And one important factor in that is how long you're going to stay in the home. So there's a break-even point. If you're going to be in the home for only like 2 or 3 more years, it's not going to make sense to refinance your home because of the closing costs. But if you're going to be there 10, 15, 20, 25 years, and you could save a point on the interest rate, it's going to make sense to refinance your mortgage. And then number 5, which is along the lines of velocity banking, and that is using a home equity line of credit as your emergency fund, and using the cash or a portion of the cash in your emergency fund and making principal mortgage payments with it. So if you've been very good with your money and you have like 6 months saved up in the bank in an emergency fund that's earning 2% right now, a strategy that you could implement is maybe taking half of that, maybe taking 3/4 of it, and paying down the principal on your mortgage. This way, your future payments, more is going to go towards principal, less is going to go towards interest, because now you owe less on that mortgage. And now get a home equity line of credit to just sit there. Don't borrow against it, just have it sit there and act as a backup to your emergency fund if something were to happen. But there are some risks to that with the home equity line of credit. If we go through a recession, the banks could pull it from you or freeze it on you. That did happen in 2008, 2009. So it's just something you want to be careful of. But in my opinion, that's a better way to go than the velocity banking, which is basically borrowing money to throw at the mortgage. This way, you're using, dead money that's sitting in your savings account that's not really earning anything. You throw it at the mortgage. You have the home equity line of credit act as your emergency fund. I think that that's a better way to do it. But unfortunately, when it comes to paying off your mortgage faster, there's no easy button. There's no simple, ninja trick that people aren't telling you about. It just doesn't exist. The best way to do it is to pay more towards your mortgage. The question is, should you be doing that? Should you be paying more towards your mortgage, or should you be investing that money in something else? And that is a discussion for a different day. All right, so that's it for this one. Hopefully you found that helpful. Hit that subscribe button if you've not done so already. Please hit that like button if you enjoyed this video. I will see you again in our next one. Thanks a lot.